Perfect. We'll start the event this morning and let people join as we go through this. I want to make the most of this hour that we have together, though, and with Jessica. So next slide, please, Margaret. I'd like to start today by acknowledging that BRC and myself are headquartered in Treaty 7, the traditional territories of the Blackfoot Confederacy, the Stoney Nakoda First Nation, the Tsuut'ina First Nation, and it is home to the Otempimswak Métis government of Districts 5 and 6. Uh, I would also like to acknowledge that we're all coming from different places across Canada and we have deep connections to the land. I would encourage everybody to share where they're coming and joining us from today in the chat. Next slide, Margaret. Just a quick rundown. I will not be taking 10 minutes on the welcome and introduction. We'll move pretty quickly into Jessica Butt's presentation. It's what we're all here for today, and I know I, for one, am excited to hear about the current state of ESG goals and activity in corporate Canada. Why don't we go to the next slide? Really quickly, for everybody here should know the why BRC Canada, because you are the participants that make up BRC Canada. Really quickly, I just wanted to highlight some of the things that we've done this year, and we're in the process of to advance some of these areas. So coming out in the next month, I believe, is our brand new PPA playbook from decision to deployment. So this will actually walk members through step by step in the PPA process. This is taking our buyer's roadmap that is much more at the conceptual categories and kind of walks you through the overall process down to an actual decision tree and step-by-step playbook for executing a PPA. Really excited for this resource and think it'll fill a really important gap in our offerings. Building off of the topic of today, everybody should be excited and keep your eyes open for our From Pledge to Power report coming out in May of this year, where we looked at the top 100 companies in Canada and translated their Scope 2 reduction goals into the amount of renewable energy needed. We're breaking this down by industry as well as by province to get at what is the actual demand for new renewable power between now and 2030, 2040, and 2050 to achieve just the top 100 companies' commitments to decarbonization. And then throughout the year, we'll be continuing to host events to try to bring greater insights, especially in some of the market challenges of Alberta, to our members. Next slide, Margaret. If you haven't seen, it's an exciting Q1 update for the deal tracker. Yes, there is an Alberta deal on that 2025 down there. That 6 that is not very visible was actually the Deep Sky deal. Just wanted to highlight it, A, because Deep Sky is a great member of BRC, but it's also the first of what's becoming a suite of carbon dioxide removal deals in the province. So having a lot of interest from carbon dioxide removal developers. At the pilot stages, these deals are quite small. As you can see, that 6 megawatts covers what Deep Sky currently needs for its operations. I think the really exciting thing is that a lot of these developers who are partnering with Deep Sky are already looking at their kind of 10x test facility and then 10x deployment facility on top of that. So see this as a great growth opportunity for renewable developers as well as the carbon dioxide removal industry. The big thing about this graph, though, is a new color. It was really exciting for the first time to be able to include Nova Scotia, the first new province on our corporate deal tracker. Nova Scotia's Green Choice program, which we've been working with the province for the last couple of years to kind of help drive that forward, officially announced the deals and corporations involved with it this year. We do know that this program's already subscribed for another tranche and look forward to seeing this grow in coming years. Next slide, please. Just quickly want to highlight the amazing community, many of which are here today that make up the BRC participants. We could not do this work without you and for you. At the end of the day, we are here to help accelerate and drive renewable procurement within Alberta and Canada more broadly. Next slide, please, Margaret. And from our gold to our silver developers, I think that we have an amazing community of committed and engaged participants, and I'm looking forward to what the rest of the year can bring for the community. Next slide, Margaret. Um, I'm sorry, I'm looking at this and I want to say, yes, this is the network of BRC, the energy buyers, developers, and intermediaries. We actually have representatives from across the community on today's call, and I think it really highlights what BRC does best, which is bring together the different aspects of the market to really drive forward for solutions that work across the whole. Next slide, Margaret. This is what I really wanted to get to. I'm excited to introduce Jessica Butts. Next slide, please. Jessica has an amazing bio, which I will not be reading in full. I want to highlight that Jessica is the CEO of ESG Global Advisors and brings that expertise to this conversation today. Prior to joining ESG Global Advisors, Jessica was a senior director with the Delphi Group, as well as working for the International Institute for Sustainable Development. Jessica brings a wealth of experience and has presented for BRC before. This is a great chance to bring her in at a moment where there's a lot of questions around ESG commitments and where we're going in this field. And so without further ado, I want to turn this over to Jessica and get to the meat of today's presentation.
Great. Thanks, Jordan. And just audio check, everybody can hear me and see me okay? Wonderful. Okay.
I'm sorry, Jessica, I do have to interrupt because I forgot one important piece of
Yeah.
housekeeping that I'm going to make for a sticky note next time. We do have a Q&A feature enabled for today. So if you have questions throughout the event, please, at the top of your screen should be the Q&A section. Send those in, and I'll curate those as we go for the question and answer section at the end.
Yeah, thanks, Jordan. And it's also going to, just underscore that happy to make this a conversation. I know lots of folks are interested in some of the insights, but certainly bring your own perspectives from your vantage points as practitioners. So certainly to the extent that as Jordan and others know, I started my career in sort of the carbon markets climate space. I'm nowhere near as in the weeds on the renewables market side of things as I once was. So hope to be able to kind of marry a bit of the top down here in terms of some key market drivers and capital market expectations with the bottom up expertise and technical and market insights that BRC brings to the table. So without further ado, next slide, please. For those of you who don't know us, just a very quick shameless plug, ESG Global Advisors, we've been around for just about 6 years now, founded with the mission to bridge the gap between corporates and investors on ESG. I'm really proud to say that we continue to do that. It's an ever-changing landscape, of course, as we will talk more about today. But really, our view and the work that we do is all founded on a key belief that there is a need and an increasing need for companies and investors alike to consider, what might traditionally be considered non-financial factors, right? Environment, social, and governance issues, alongside financial metrics when we're talking about value creation, value destruction. So to the extent that we see these issues as material alongside other key business drivers and issues, that's really what our work is all about. Next slide, please. Great. So in terms of what I'd like to cover off today, there is a deck obviously here. If I'm not mistaken, it has been or will be provided to folks as a resource.
After.
Yeah. Perfect. Okay. So I may skim over some slides more than others, and again, very much welcome questions and perspectives from the group. So please don't be shy. But want to start out with a little bit of level setting on some key concepts and market terminology, because I think that's half the battle in the alphabet soup of what's in and what's out when it comes to acronyms, and then really dive into some of the key trends and market dynamics that we're seeing actively play out here within the broader, of course, macroeconomic context, and then talk a little bit about implications for BRC members, and certainly again very much see that as an active conversation that you'll all have insights to bring to as well. So next slide, please. So you can go to the next one. Thanks. So I almost always, no matter what the topic, start my discussions and presentations with some version of this slide. And reason being, I think, as I mentioned, the terminology and the framing of ESG and sustainability issues is half or maybe even three-quarters of the battle at this point. Of course, there are different schools of thought here in terms of how we define, CSR versus ESG versus sustainability. But from our perspective, and I think the maturing market perspective, thinking about the issues as almost two sides of the same coin can be a really helpful sort of framing here. And so, of course, what we saw emerge in the last 10 years or so, right, was an evolution from more quote unquote traditional corporate social responsibility, right? The idea of corporate values. What are the impacts, the positive impacts and contributions that a company has on the environment, economy, and society around it. We really saw an evolution of that framing and of those issues to one of ESG, and really seeing the link, as I say, more clearly to value, financial value of an organization, right? So the extent to which those impacts, positive or negative, that a company is having either on the environment, economy, or the inward pressures and drivers that it's facing. How do those issues play out and impact the balance sheet of an organization? So it's helpful to think, as I say, about this from sort of that inside out perspective when we talk about CSR versus outside in when we talk about ESG. And the key, I would argue, the key kind of determining factor in your framing is really your audience, right? And who are the stakeholders, and what is the language that you're sort of looking to speak and communicate through your strategy or your tactics. It's interesting, and again, we'll get into this in terms of the drivers, but the extent to which now, with sort of the hyper politicization of ESG, we see a lot of folks actually shifting back to either CSR or kind of even broader terms of just sustainability or of corporate responsibility. Resilience is another key term, which I tend to like the most, and it'll be interesting to see if that sort of becomes the next evolution. Next slide, please. So fundamentally, as I say, whether kind of arose by any other name, regardless of the ultimate terminology, what we're talking about when we're looking at and trying to communicate around ESG and build strategies to respond to those risks and opportunities is, as I've noted, really about seeking to identify and manage those material issues that are traditionally non-financial. So that doesn't mean, of course, that every ESG or every sustainability issue should be a priority or should be is relevant to a given organization, right? It's gonna vary significantly, right? Sector to sector, geographies, the nature of the company in terms of its ownership, its structure. Are you publicly traded? Are you not? Um, but it fundamentally is about you think back to economics 101, we're looking to price the externalities, right? That's really what we're talking about when we talk about ESG. Next slide, please. And so, of course, that's, in many ways, that's easier said said than done, as we are living through in a variety of ways as of late. But again, I think at a macro level, really important to ground us in the reality that when we talk about or think about the intersection of these, again, quote unquote, non-financial risks, whether they're recognized as such or not, they really are and have become incredibly pervasive, right? And the extent to which I like to use, or I think it's sort of instructive to look at the World Economic Forum's annual risk survey. Of course, they talk to a few hundred global corporate and political leaders and ask them, what do you see as the most significant, most material risks in the near term, being 2 years, and sort of out on the horizon being 10 years. And what you see here, of course, is the 2025 results. The trend has been very similar for the past, I'd say, 5 to 7 years, whereby, looking at this, the list of factors and the color coding, this is the World Economic Forum asking what are the top risks, and not one of the top risks are sort of purely economic in nature, right? Based on the categorization there, and certainly seeing those environmental, tragedy of the horizon, if we want to call it such, issues really coming to the fore and materializing in that sort of midterm outlook. The other really, really important piece here, I think, to flag, and that certainly carries through when we talk about implications for corporate strategy, is, of course, the highly interrelated nature of many of the risks, not only within ESG, but just within the sort of full business risk landscape that many of you are operating in at this point, and the extent to which, of course, many of these issues overlap or influence, catalyze each other, right? I think a great, or not a great, but a really instructive example in that context is sort of regional conflict, right? And the role that climate and severe weather or droughts, other changing weather patterns, etc., can not only have as a hypothetical, but has already been shown to have been a significant contributor to, for example, the civil war in Syria, and beginning to incite the Arab Spring and whatnot. So all to say, highly interconnected, right? And that really is the name of the game when we talk about ESG more broadly, and certainly the corporate strategies and responses associated. Next slide, please. And so, what does this look like in terms of how are the capital markets, how are investors, how are corporates ultimately trying to navigate in this increasingly complex environment? To the extent that we've seen a massive maturing of the market on this front in the last really 10, 15 years, a lot of the, a lot of the hyper politicization, a lot of the headwinds that we're facing now, which I will absolutely be touching on, turning to next. But a lot of that is in response to significant growth and maturation in the market, and to the extent that it's almost followed a bit of the kind of I guess it's the hype cycle, right? Like the idea that you sort of have this maturing of a market or uptake of a product or an idea, and then you have a bit of a right sizing around and a pushback too, right? And so the extent to which you have this essentially a spectrum that's evolved around how investors and of course corporates on the flip side of that are looking to understand and integrate these ESG considerations into their investment decision making, into their capital allocation, into their portfolios. There is a broad range, of course, in how in how this is approached. And again, this is an area where there's a lot of confusion, a lot of false equivalency here in terms of the size of the market and things like that. So we find, and we developed this, we continue to update it, but we have developed this a few years back to try to put some clarity around the different approaches. And it's really helpful, again, if we go back to that sort of, the values versus value idea that I mentioned a few moments ago. If you think about the spectrum here from traditional investing, which is solely focused on financial returns, through ESG integration, and then sort of varying degrees of exclusionary or seeking either exclusionary around, thou shalt not invest in, tobacco, firearms, etc., through to impact investing, which is really about seeking positive return and positive impacts rather, which may come at the sort of cost of some sort of traditional return piece. And so important here, the key message is 98% or so of institutional investors apply some form of ESG integration into their decision-making process. Again, that doesn't look the same across every investor nor asset class. But the consideration of ESG issues alongside traditional financial metrics is very much pervasive in the market, and that's a as I say, been a significant contributing factor to some of the challenges that have evolved. But I think really important to underscore that the intention there is not to seek out, again, or not to seek not to take ESG into consideration any more or less than traditional financial metrics, but rather alongside and seek those risk-adjusted returns fundamentally, right? And so that's really where the vast majority of the market, the regulators, the political conversation is stemming from and sitting at this point. I know I've thrown a lot at you there in terms of kind of key concepts and some of the framing pieces. Before we dive into some of the key trends and pushback and the fun stuff, any questions, comments, perspectives that the group wants to share?
Nothing's come into the Q&A yet, but I'd also say, like, feel free to throw your hand up. I know Jessica said she wants to make this conversation. I do have a question coming off of that. I noticed you said that 98% of institutional investors are at the ESG integration stage. Do you have a sense of how many have moved into the thematic investing or impact investing?
Yeah, so it's it's a much smaller subset that have sort of specialized thematic investing, either portfolios or sort of teams and mandates. The Responsible Investment Association every year puts out a great sort of state of the market that breaks out. They don't use this exact nomenclature, but something similar to help sort of understand the relative weightings in the market. But as an example, impact investing, like purely impact, as I say, sort of seeking those positive impacts, is only about 3 or 4% of the overall sort of responsible investment spectrum. So that kind of gives you at least like an order of magnitude perspective. And certainly, again, the types of investors are going to vary, right? You get more into the specialized, some of the PE or the foundations philanthropic pieces, right? Tend to go more towards, or those folks in the impact and sort of outward screening space tend to be overrepresented in those asset classes.
Okay, thank you.
Yeah. Any other questions? Matt.
Hi, Jessica. Thank you.
Hi.
Sorry, I'll turn my camera on here. I've been sort of following the discourse of ESG in the news over a few years, and I'm curious what your experience has been. I've sort of noticed there's some discussion around the pendulum swinging back in the other direction around this sort of anti-woke investment approach, right? There's sort of been maybe an overabundance of focus on ESG. I'm curious if you can comment on what that's done to the industry.
Yeah, it's a great question, Matt, and that is actually a fantastic segue into my next slide in the next section, so we can pop there while I answer your question. So to the extent that you're absolutely right, and I think that in terms of the pendulum swinging back, there was and still is a to a certain degree a necessary kind of right sizing, right? Because we were in this place 3-4 years ago where like everything was an ESG labeled fund and everybody had an ESG strategy that was best in class and everybody had targets that were completely unachievable, and surprise, surprise, lots of them have been rolled back or just sort of quietly no longer reported on. But from a funds like flows perspective, what we actually saw, again, from that ESG integration perspective, at least in the last 2-3 years, was yes, there was a slight decline in terms of overall fund flows towards ESG, but not the sort of precipitous, like complete drop off and decline that I think certainly the political environment would have had you sort of believe. I don't have the stats right off the top of my head, but the RAA report that I just mentioned has some really great trend graphs to exactly that point, and certainly there's also sort of the anecdote from Larry Fink, about 2 years ago when a number of the U.S. state pension plans started making noise about, or in some cases actually, pulling their investments from BlackRock management on account of the ESG. Sort of, again, that kind of anti-woke piece. But his view was that at that time, again, things continue to evolve, but at that time, the relative impact on their overall portfolio was not even sort of material. So again, I think this kind of goes to, and if we can go to the next slide, Margaret, it'd be great. And sorry, the next slide. Yeah. This kind of goes to this whole question of, are the in light of the political pushback, broader market uncertainty across the board, not just obviously specific to ESG, are institutional investors sort of writ large going to stay, quote unquote, stay the course and sort of continue to backfill the policy and regulatory gaps that was why they first came to a lot of this, that came to this space in the first place from that fiduciary responsibility perspective. But that those gaps were starting to really close, right, in recent years with standardization of reporting frameworks and securities regulators looking to regulate disclosure, et cetera. So that's, I think, that's the big question for sort of 2025, 26 in terms of how pervasive will the political sentiment be, or will we kind of continue in a bit of this no man's land of like somewhere between greenwashing and green hushing, right? Is like where we seem to be vacillating.
Thanks.
Yeah.
I just wanted to add
Yeah.
on one point there, because I think the great point you make too is that it under another name too in a lot of this, right? Like when you look at like investors coming into this from a fiduciary responsibility, one of my favorite facts is across the academic literature still, out of the three categories of environmental, social, or governance metrics, when you look at firm performance and try to start to disaggregate those three, governance has the least impact on performance, environmental the highest, and then social higher than governance. So I just from that perspective, I don't think firms are going to be able to ever turn away from these. They might not, the framing of that, to your point, Jessica, might change, but these have material impacts on their business that they have to address.
Yeah. Yeah. And on that piece, like it's been really, really interesting. And again, we really only have, like, at this point, we sort of have like 2 quarters of complete chaos to sort of try to make trend lines out of. But one sort of quote unquote trend that we've been seeing, and certainly in our like work with some of our investor clients, is actually now, if we're talking about dismantling ESG as sort of an umbrella acronym, or it's the thing you can't say out loud, there's a school of thought that particularly the institutional investors are now going to focus that much more on the G, on the assumption that if you have good governance, that necessarily precipitates more effective risk management and strategy on the management of the E and the S, right? So I think that'll be really, really interesting to watch, because you have that trend up against a flight of capital to the private markets where it's not as sort of black and white as to say that public companies good, private markets bad from a governance perspective. But I think we can all appreciate there are very different governance expectations, and in fact that's been that's kind of my first point on here, but that's been one of the, I think, very real kind of critiques of ESG in recent years, is just that the sort of continual raising of the bar in terms of expectations, resources, reporting requirements, box ticking exercises, et cetera, that companies and investors, for that matter, are going through, and really a bit of a sort of a not a come to Jesus, but a sort of real questioning of what's, have we actually seen the value out of this, right? From a performance perspective and access to capital perspective. And certainly there were the past few years, particularly coming out of COVID, like I would argue that was the case. It was just table stakes expectations that thou shall have an ESG strategy in some shape or form. Now, of course, that gets broken apart with some of the political and market dynamics. But at the same time, Jordan, as you said, this is the framing that is absolutely still resonating, is dependent on your sector, right? Those material factors that make up ESG don't go away as foundational business risks, right? I think I often give employee health and safety. If I'm a mining company, I was calling it health and safety before. I was calling it my top priority within my ESG strategy I have an ESG strategy, and maybe I'll call it health and safety again, but it is still your number one business risk, full stop, in many cases. So I think that's where, again, there's a lot of helpful elements of sort of bringing ESG together, but the unwieldy nature and again, some of this political pushback is starting to push us back to more of a factor by factor consideration when it comes to at least the sort of management and strategy elements. Other thoughts or perspectives or questions on the political sentiment piece? I think, it's obviously too early to tell, but I do really think that, and I know Pembina just put out their federal policy briefing there. I think it will be very, very obviously instrumental in one way or the other, the federal election outcomes. But to the extent we're sort of back, seemingly almost regardless of outcomes, we're kind of back to that, again, that bifurcated approach, certainly from a policy and market perspective, on a state by state or province by province level that we had started to come out of, or thought that there was a light at the end of the tunnel in the last few years. But that certainly, at least in the U.S., absolutely does not, that national or North American approach is certainly seems to, hopefully not in the complete rearview mirror, but certainly not not looking overly promising for the near future, looking ahead either. Other thoughts or perspectives on the political piece? I did want to highlight a few other headwinds too.
Nothing in the Q&A. I think we can.
Okay, great. Maybe next slide then, please. Okay. The other, I think the important piece with I've touched on, I think, a number of these in terms of just the massive growth in sort of ESG expectations, frameworks, standards, etc. I do think that especially as a practitioner in this space, as an advisor in this space, and what we see in the market, it is really important to delineate between the the sort of more or less valid or constructive critiques and challenges that folks, different actors in the ESG space are facing, versus just the sort of general ESG political backlash that is sort of the next iteration of what climate denialism or now is being sort of sicked onto DEI, etc. To me, it's a whole other conversation or set of tools, if they exist, on how to sort of manage and navigate that. But certainly within that maturing of the market, as I mentioned, there have been very real challenges, critiques, issues that have evolved. Some of them were on the previous slide there, in terms of the governance challenges, but also the very real inconsistency, right, in the reporting standards that different companies are either required to align to, dependent on, again, their investor base or the geographies that they operate in, versus what their peers are doing, what their clients and customers are expecting, etc. And certainly, We see, relevant for this group from a real economy perspective, some, very real structural and market challenges, of course, in sort of the investment side of the equation, right? It's one thing to have a strategy, it's one thing to have targets, but then to actually implement those from a transition perspective. I suspect I don't have to tell this group about some of those challenges. Next slide, please. And then, yeah, just the other, I think, key piece, and I know there was in the pre-event poll, there was a flag on this too around C59. Obviously, yet another sort of headwind in some cases, for sure, around issuers' willingness to continue to report and disclose these around ESG issues for fear of litigation or and that historically was much lower in Canada. Now with C59, there are mechanisms for private individuals, for groups to bring forward greenwashing claims, rather. And I think this is again an area where there are very real challenges and concerns around the disclosure reporting of, again, non-financial issues. These are, and it's a new area, right? It's the finance folks looking at, not that they don't fundamentally understand them, but they're looking at metrics, they're looking at frameworks, they're looking at standards that they aren't used to engaging with, that are, many of which are being sort of built in real time. And there's very real concern from various functions within most of the organizations we work with, whether it's legal, finance, risk, around the trade-offs with disclosing and fundamentally, I think there is the North Star, right? As if we go back all the way to sort of my initial comments, the North Star of treating and managing these non-financial risks alongside financial risks means that you treat those issues and the reporting, both internal and external, around it with the same level of sort of rigor and robustness that you do your financial reporting, right? And so, again, these are new muscles, these are new functions that are needing to be built out within organizations. And so, to the extent that, I think, again, some very real, very valid concerns and challenges. On the other side of the spectrum, though, in our mind, that's not a reason to sort of take a blank slate approach, or not report and disclose anything. There's a lot of room for pragmatism still, despite I would say despite some of the political pushback and challenges that, again, we don't want to underweight at the same time. Okay. So I did just want to highlight before I sort of open it up to Q&A and a broader discussion. I did just want to highlight a few kind of key trends here from in terms of how we're seeing this play out, and in the current kind of investor and corporate landscape. Certainly, I mentioned the question marks that I think we all have on a number of fronts, looking over the horizon, but certainly really seeing this kind of push-pull and this dichotomy play out around the expectations that ESG and climate, being a key issue within that, are being actively managed and strategized around within organizations versus sort of the managing the political elements. And so, you see the latest this data is just from this year's proxy season, so quite relatively fresh off the press here, and you see again an expectation, kind of top of the list, right, is climate environmental performance as a continued expectation of investors in terms of ESG and broader risk management for the companies that they're engaging with. Again, this is largely from a public markets perspective, of course, from the proxy perspective, and so, but you see, some areas, if we just compare 24 to 25, things like human capital management are starting to become more and more important again, but really not again a precipitous. You don't see a precipitous drop off there in terms of certainly climate expectations in at least in this year's sort of outlook. Having said that, if I go to the next slide, please. Yeah. I love to show these, or I found these a little while ago, and I think it's again, to me, it's just like perfectly illustrative of the cognitive dissonance here. You have in terms of how the corporates are then navigating the market expectations. So you have on the left is a targeted survey that I think Bain and a few other partners did of I think sort of largely US-based CEOs. I'll caveat that, but you see a sort of complete drop-off, apparently, of sustainability as a priority for CEOs in the last couple of years. But when you look at the issues that are on the rise, right, it's all in many ways ESG related, or again going to be highly influenced and impacted by your ESG strategy or management of ESG risks or lack thereof. And so again, I think this sort of cognitive dissonance around the connection points is really fascinating. I think we also see that play out when, in a lot of reactions and responses to the infrastructure and asset impacts of like extreme weather events and whatnot. We tend to see that a similar sort of narrative. And then likewise, you see again, folks are absolutely at least from an investor perspective, the investor relations and leadership, corporate leadership, again, precipitous drop off in the actual naming of ESG on earning calls, right? And so you see that those trend lines follow almost exactly the sort of massive growth in the market and expectations through coming out of COVID. And we don't have Q1 results here yet, but I suspect it would be even lower there in terms of S&P references. But again, this all comes back to the broader landscape within which these companies are navigating, and still a lot of uncertainty around how much of this is truly a sort of complete rollback of ESG strategies or understandings of those risks internally versus what are we saying or not saying publicly. And so I will I'll just like maybe end off by noting again without boring everyone too much further on the reporting landscape piece. But again, we put together this graphic a couple years ago to really just help underscore again the sort of North Star vis-a-vis the treatment of non-financial factors alongside financial factors and reporting. That is absolutely what the key reporting frameworks that have now disclosure frameworks that have now evolved globally are looking to do, and so much so that we now have the International Sustainability Standards Board, which sits within the same organization that sets global financial reporting standards, right? So the extent to which, again, we are there's different languages being spoken for sure, but if we rewound 10 or 15 years and that conversation was miles apart, right? You had things like the UN SDGs and the GRI, which did incredible foundational work on that sort of CSR side of the equation, but really now in a place where don't know that sometimes I joke, I'm like, don't worry, the accountants are at the table, it'll be fine. But no, I do think that that's, to me, that's part of what is so fascinating and so exciting and interesting and challenging about the ESG space is that reality that no one of our sort of business functions, business units, areas of expertise is going to solve for or be able to alone be accountable for an organization's strategy and performance in these areas. It really truly does take a cross section of the organization to effectively integrate ESG and into a corporate strategy. So with that, I will maybe just, Margaret, do you mind maybe just flipping to the implications for BRC members slide, and we can kind of open it up to discussion. And yeah, happy if there's other views or questions from the group.
So I'm going to jump in with my first question while everybody else can get theirs prepared. Please feel free to raise your hand or throw it in the Q&A. This did come in on our pre-event survey, and I wanted to add a little more color to it. So going back to Bill C-59, one of the concerns I've heard from buyers is that they're worried that even the claim that they're using 100% renewable energy would now have them running afoul of this regulation, because in the virtual power purchase agreement, it's essentially an offsetting mechanism, not a direct use of power.
Yeah.
When you're talking with clients, how are you advising them to think about these kind of granular issues?
Yeah, it's a great question, and I think that is so the extent to which C-59, certainly in their reference to internationally recognized methodologies as the guideposts, on the one hand, did the market a service by not being hyper prescriptive, right? It wouldn't have been their place necessarily to do so. But on the other side of that equation, you now have concerns, discussions, challenges, very big uncertainties around, well, then what is the litmus test? What is credible in terms of staying on side from a C-59 perspective. On the one hand, we will start to see, I know the banks are all rather terrified that we will start to see the cases come in this summer, or at least first cases in the C-59 context. And so the extent to which, the advice that we have been giving clients is, ideally you weren't making claims before that that weren't sort of backed up by a credible, third party, verified and or audited and or, internationally recognized standards, market, etc. And if you were if you were making bogus claims, well, then that's exactly what C59 is intended to try to weed out. But if you're otherwise on side, the credibility piece really then comes down to ensuring that, in stating 100% renewable power, you are also clearly articulating, within the same paragraph, what those standards are that you're accredited to, what markets you're in, as much sort of detail and transparency as can reasonably be provided around the nature of the strategy and of the investments. That's that's really what, again, this is about. It's not or it shouldn't be about limiting the limiting market mechanisms, limiting flexibility of organizations in sort of their investment decision making around the transition, around meeting their targets, but really trying to sort of put some guardrails right on and drive towards that alignment with sort of quantifiable, verifiable, transparent practices.
I think that's great. Something I like to highlight for BRC members is we've always had a very stringent view of what counts as a PPA that we incorporate in our tracker for that reason, and particularly focusing on some of the evolving additionality standards, and essentially for that. So we could always point to and say it clearly meets best across standards, best practices.
Yeah.
No questions have come in yet. I assume the audience is digesting the wealth of information, and I will say for everybody, we will have the recording of this, as well as Jessica's provided a PDF of this slide deck that we can send out. One thing that kind of struck me as you were going through seems to be the divergence between internal focus and external focus on this. Someone looking at what investors are caring about, or even CEO concerns. And then looking at those two, I'd say, dramatic slides of the fall off since 2018, do you think we're entering a period where we should, the way I've been saying this is we didn't trust companies in 2015 when they started saying they were doing great things. Why should we trust them now when they're not talking about it? So is it really that we're just in the same, we should be following the money, and that's where we should really be looking to see what companies are doing?
Yeah, I mean, absolutely. I think, again, we can't discount the potential, further chilling impact that that just the broader macro instability is likely to have in the near term, right? It is still, as much as the market and sort of the reasonable and mature investor and same reasonable and mature corporate has built out a foundation of some sort, or has varying degrees of maturity on how they're managing these issues. It is still very much the case for if you kind of thinking about the market as the pyramid of the leaders, and the vast majority are kind of the fast followers, or mid-market. It's that mid-market and those sort of the Peloton group that was clamoring to up their game these last few years, and it's those folks that with for example the chilling of securities regulation from a disclosure perspective, as well as just again the broader investment landscape. It's those folks that I think the resolve is really going to be tested, and the need for those the real sort of business case behind these issues, it continues to be the front and center. And so again, that's where the business case piece, if you are a large multinational company that has sophisticated institutional investors, like, okay, so you're not shouting at the rooftops ESG in the Rust Belt, but you're still doing almost all of the same things, right? Whereas if you're a small privately held, project developer in a US state, again, it's gonna look different, but I can guarantee you that, from a broader stakeholder expectation, from a talent attraction retention perspective, right? The table stakes expectations around ESG are still they may be chilling, but they're still the baseline's much higher than it was even 3 or 5 years ago, I would say.
I think it's a great point, and as we end this, I want to really just highlight for both sides of the call today. For the corporations on the call, won't be surprised to hear that business case is one of the biggest drivers I hear about. And I think every time we talk about, especially on PPAs, we have to start from how do we convince finance and procurement. And for the developers on the call, I don't think that'll be too shocking, but I do think that focusing in on that when you're having discussions with these corporations is going to be one of the best way to move the conversations forward.
Yeah, absolutely. Unfortunately, I do have to hop for another external meeting here, but thanks so much, everybody. And yeah, more than happy to connect bilaterally or as folks may have questions or want to chat further about what it might mean for you and your organizations.
Thank you so much, Jessica.
Okay, cheers. Bye-bye.
I know everybody does have to jump off with that. I'll just go through some closing notes really quickly. I do want to highlight our upcoming events. We have 3 next month in May. We are hosting Legally Speaking, Tools of the Term Sheet. Sorry, my screen went completely black there for a moment. Legally Speaking, this is an annual webinar held at different times. You get to come and enjoy the amazing expertise of Castle's law firm as we walk through what are some of the challenges in doing deals in this current Alberta market. Moving into June, we have a webinar with Women in Renewable Energy that focuses on updates on equity in the energy space, bringing us to our July in-person second annual Stampede Mixer with Castles. Last year's event was a great time, and I recommend everybody who can make it down to Calgary for the Stampede join us for a great night. The speaker has not been announced yet, but as always, we will make sure that there's some educational component so that you can send this back to your corporate and say, this is why we have to go. It's an important night to learn about power purchase agreements. With that, if anybody has any questions, Jessica's email is there. Please feel free to reach out to her. But if you would like to, ask me a question or to have me make that connection for you, please feel free to reach out. And with that, I am going to, as always, unceremoniously end our webinar. Have a great day, everyone.